What's up, guys? It's Jason from Paper Gains. Market's closed today, so I thought it'd be a good opportunity to put a little video together for you on the VIX. So the VIX has been a staple in most traders' arsenal, at least that I know of, for as long as I can remember. But recently, I just felt like it wasn't really working the way that I thought it would function. So I did a little digging and I put a little deck together. So I wanted to share with you guys what I did find. Uh, Before I get started, though, in on the presentation, I did want to point out there's typically a couple little nuances about the VIX that people don't always understand. So just to clarify some of those things up, number one, the VIX specifically only tracks S&P 500 index volatility. It doesn't track the NASDAQ or the Dow or the Russell for that matter. It's actually not a dollar. I actually, when I was really early on in trading, I thought it was a dollar. I would say like, oh, the VIX is at $20. It's a number. So it's not a dollar amount. You can't actually own it or trade it. It's only tradable through futures and futures options. And there are two. One is an ETF, one's an ETN, but UVXY seems to get confused quite a bit with the VIX. But specifically UVXY, it's not the VIX. What it is, it's a 1.5 leverage ETF of the daily volatility of VIX futures options. So it's not looking at the S&P 500, unlike the actual VIX. It's looking at options on the VIX, futures options on the VIX at that matter, and only the daily snapshot value of those. And it's actually, I mean, it's designed to go to zero. So please, 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 guys, don't be that trader referencing UVXY levels for charting. If you're going to be looking at UVXY at all, keep that stuff intraday only. There's another thing called the VXX, which is an ETN. It's a little different, a little bit better structure, but at the end of the day, these are both derivatives of a derivative that I'm about to tell you is pretty much broken anyway. So I guess there's that. Anyway, so what is it? So the VIX is actually a benchmark of S&P 500 volatility. A lot of people call it the fear gauge. You'll hear that a lot on TV. And specifically how it works, and this is what I wanted to find out, was it measures volatility through SPX option volatility. So if you're an option trader in the market today, you know that SPX has become like exceedingly popular, and they've made some pretty big changes to the option chain on SPX that are totally changing the landscape for option traders as a whole. Some serious game changing stuff. But I think in the advent of some of those things, it's had a major effect on the VIX index itself, and unknowingly so. So when I looked into it, what I found was like how I wanted to find out, how does the VIX actually calculate volatility? Well, it turns out it specifically uses SPX calls and puts options on at a very specific interval. So specifically 23 days to 37 days to expiration. That little snapshot of time, it looks at call and put volatility of those SPX options. Well, at the time, and this VIX index was started in 1993. There were only like weekly, monthly expirations. I'm not even sure actually that there were even weekly expirations, but most of the volume at that time was probably, and I'm assuming here, probably around that 23 to 37 days to expiration interval. And today, the SPX option chain doesn't look anything like it used to back then. Literally today, there's an expiration for every single day of the month for the next, I don't know, like 30 something days. So, you know, back then you didn't have the ability to buy, oh, okay, I want to buy 4 days to expiration because I want to capture this event or protect against this event. It'd really be very limited to the choices that you had. And so what does that do now that you don't have to buy weekly only options? What does that do to the value of those 23 to 37 DTE expiration, days to expiration options now that there's not that same demand that there was for them back in the 90s? It just doesn't exist. There's no need for it. So the advent of 0 day to expiration options, and just that there's new series of expirations, completely changed the market essentially for those specific expiration options on SPX now. So the problem now after that is like, where's the volume, right? Where does the concentration of volume lie? And so my gut was telling me, look, there's all this 0DT stuff going on. So I went to bar chart. I pulled, you can do this. You can search any underline and do an export of all the volume and open interest. So open interest is who's holding things overnight coming into the following day. Volume is what's been traded that last trading session. And so when I pulled the volume and open interest metrics for SPX, like what I found was that like only 10% of the volume, and this blew my mind, only 10% of the volume was actually in that little snapshot of time that the VIX looks at. I mean, like, could it get any worse in terms of volume? So like the lower the volume, like the low, people aren't bidding things up or down. So the volatility of those call and put options is going to be probably, I mean, there's just not the demand for it, right? What I'm seeing here when I actually look at the numbers is like, look, and I know for sure institutional traders are trading nearer to the money, nearer to expiration, as well as retail traders. The majority of the volume, and you can see that in today's like export, 57% of the volume was below 23 days to expiration, less than 23 days to expiration. Actually, when I dove into this even deeper, it, you know, the majority of that volume was that same week expiration, if not that same day. Everything else is like hedge kind of stuff, and that's way farther on than 37 days out. And what that's left with is just a very small market of the snapshot that the VIX is actually looking at. So what does this mean for the VIX moving forward? I just don't think it's as reliable as it used to be, not with this new 0 day to expiration thing going on in SPY or SPX or SPY, but the market for index options is kind of changing. And unless the VIX index itself changes with it, I don't think it's ever going to get a proper reading, at least not the way that it used to be. So that said, I'm like, well, what do I do now? What can I look at? So there are two things, but the short of this long is that, look, the VIX isn't going to work. It's not going to be as accurate, mostly because nobody trades the SPX options that it actually looks at. It's just not going to get a good view. So what do we do, right? If you didn't know, this last year and probably this coming year is all going to be inflation. And there are two forward-looking things that you can look at intraday as a possible replacements to VIX. And I'm going to go over a couple of them. Let me do this. Let me look at this. I'll get you guys here. I'll pop my little face up here. So here's SPX, and here's what I want to do was the 2-year yield. So I think this is probably going to be the most important. And as long as is the caveat, as long as there's a yield curve inversion, I think the 2-year yield on TradingView, it's US 02Y. The 2-year yield would represent what does the treasury yield look like for the next 2 years, give or take, right? Probably, I mean, the average yield. And so here's the thing. You ever heard that the 210 curve, yield curve, they say the yield curve is inverted, right? What are they talking about? They're talking about this 2-year yield against something called, well, against the 10-year yield, which would be US 10Y. And that's right here. So the difference between the two. But I want to look at the 2-year specifically, because that's going to give us the most recent data and the one that's going to be more important from an intraday perspective. So if the 2-year yield or interest rate on the 2-year bond is going up, it's likely going to be going up faster than the 10-year bond, most likely. And if that's happening, then the distance between the 2 and the 10-year yield is widening. And when that's widening, that curve is widening and the inversion's getting deeper. And so when that's happening, especially even intraday, well, that's not going to be bullish for equities. It's going to be bearish. So you could probably see, you can actually look at this intraday sometimes and you'll see, okay, well, the 2-year is going up, the 2 years going down, 2 years going up. stocks are going down. 2 years going down, stocks are going up. It's not an end all be all, but it's a good, as long as there's a curve inversion, I think it's something that you can add to the arsenal. It's going to be fairly good from a gauge read, like just a replacement of that fear and greed index kind of gauge read. The other one is the Dixie. So DXY is the ticker. And if you traded with me at all, like, like the Dixie has been probably the most important chart in the market for months and months now. But the Dixie, what it is, it's the US weighted, it's the US dollar weighted against a bucket or basket of other large global currencies. And the thing is, like, if the value of the dollar is going up, then what we value the dollar in, this is very short-term perspective, isn't changing. So therefore it costs less dollars to buy the same amount of whatever it is that we're looking at. Very short-term myopic view, right? So therefore, dollar up, stocks down, everything down, gold down, silver down, dollar up, bearish. You can see that happening intraday. I think what I'd say with this one is that the dollar's come down quite a bit. So it's not, well, the yield curve is inverted, and I think where we are, this would be a backup to that 2-year yield. And if you've been using the Dixie for the last few months, I think it's time to switch over to the 2-year yield and start looking at this as your replacement to the VIX. So that said, let's get into this, right? So the Dixie is your backup, and I think the 2-year yield treasury bond is going to be the best case replacement for the VIX. But until they really change that calculation, we're just not going to get a good reading on the VIX. So there you have it.